So the company has a market cap of $5 billion. It's in the media industry, a price to earnings of 42. So that's big. And you can kind of see that in the price chart here that starting from 2011 up to 2016, it has grown from about $3 on average up to about $10 in a 5-year span. So it's doubled a couple times. Not bad. But that price to earnings ratio already is sticking out to me. Even worse is the fact that their earnings per share compounded annual growth rate, so the annual growth rate, is down negative 49%. That is a big concern, a red flag. We're going to definitely need to dive into that more. That's just something you don't want to see from a business that you own. You want to see those earnings continue to grow and also ensure that they're not over diluting shareholders. Now, moving on to the advanced metrics here, you can see a gross margin of 32%. So that's okay. That's nothing really special. Really what I like to see is a range between 50% and to 70%. Even above is better, but a 32% isn't too great here. We can look at an operating margin of 4.5%, also kind of mediocre. It's still positive, which is a good sign, but it's nothing that stands out in particular. And then lastly, net profit margin after interest and taxes are paid for, you're seeing about 2%. So the company has a very little amount of cushion. And what this highlights, I think, more than anything is when you're looking at media businesses, you're competing with a lot of different alternatives out there. And it's a content game. You either need to attract producers in different shows or movies that are able to kind of attract people in and keep them viewing, but there's also many alternatives out there, and people nowadays especially bounce around. So that's at least one point of concern. And unless you have a healthy margin, well, there's companies like Netflix and Paramount now, Disney, there's a lot of big competitors. So if you're not one of the big boys, it's usually a lot more difficult. And again, this is a $5 billion company, so it's definitely smaller in scale relative to those big players. And of course, factoring in that this is January 2016 also is important, but just something to keep in mind. Return on equity, 6%, so that's okay. Warren Buffett's rule of thumb always was 10% or greater. And so just looking at this, it doesn't meet that threshold. That would be another X on the checklist, let's say. Revenue CAGR, so revenue growth annually for the past 5 years is about 21%. That's not bad. That's pretty good. The only problem is that their net profit is trending in the opposite direction. So what that tells me is that the company is scaling up their market exposure, but it's not translating down to their bottom line. And this can usually be a major risk for a lot of companies if they can't figure this out or if it doesn't align with their initial game plan. So from there, we can look at shareholder equity, and this is actually growing at a nice clip of 36%. I like this number. This is something that I would definitely want to look for, and I think it's pretty solid. And then lastly, looking at the 5-year free cash flow margin trend. So the thing's negative. We're not seeing positive free cash flow. I've always talked about that free cash flow is the most important of these metrics here because it is truly the cash that you retain, and it is ultimately how you value a business. So I've looked at the advanced metrics. We are going to dive into the actual financial statements because I think this is one of those companies that you're seeing these numbers, and as you're doing a thorough analysis, if you can start to understand the financial statements, you can kind of see the story behind these metrics and figure out what is going on, or at least what potential risks may be highlighted. Lastly here, looking at stock movement. So as I highlighted, the stock's gone from $3 up to $11. It's definitely appreciated. So, I mean, if you invested in this time, you've certainly benefited, and that's probably a really solid investment overall. But it's just one of those things that now you have to ask yourself, because the price to earnings so high, what's next? So I'm actually going to start with their statement of operations to begin, so we can look at revenue here. And you can see from 2009, they were making about $1.7 billion in revenue. This grew to $3 billion in revenue as of 2011. That's a really good sign. Their gross profit is also trending in a really good direction. It doubled in less than 2 years. Also really strong there. Keep moving down the line. Operating expenses have also grown at a decent clip, but nothing too crazy. And you can see that their operating income is growing at a healthy rate as well. They've essentially doubled that as well in 2 years. So looking at 2011, and this probably speaks to why the stock appreciated so much, is things look really, really good. From a net income standpoint, again, you're seeing that positive trend, all good things there. Things are looking good, but as I mentioned, net income has a negative growth rate over the more recent years. So we can start to see how this plays out here. And if we go back to the operations, we can see, okay, well, from 2011 to 2013, once again, things are looking good from a revenue standpoint. Operating income, it kind of fluctuated. So 2011 was really good, $376 million. This dropped to $50 million the next year. So that's a little bit concerning. That kind of sounds like the cost of their revenues really increased. And you can kind of see that here. There's about a $600 million jump just between those years here. They also increased their marketing push there and, research, technology, and development. I like when people spend and are trying to innovate, so that's not necessarily a concern, but it's more that element of the cost of sales here. It's becoming more expensive to build their product. So that's a big jump, and that's pushing their operating income here. And then if you trickle down to their bottom line, so net income, again, $226 million in 2011. This dropped to just $17 million. That is a huge, huge drop. Something that is a little worrying for me. Something obviously hit the company in 2012 that is quite concerning and something to be wary of. Now, to 2013, they did improve their revenue again. Seems like operating income recovered slightly, and they kind of figured it out, or at least the economic conditions improved a bit. This also trickled down to their net income, so things have definitely improved. And one thing to note is sometimes you're going to face economic conditions that really are unfavorable for a short period of time, but as long as they're staying profitable, that means they're bringing additional money in. So it's not the worst thing, but you want to see that continue. And especially when comparing against other businesses, this would be a factor that I would say, well, maybe the business model that they are operating is not as durable as other options out there where they continually just grow their profits year over year. So another sign there, but now's the real story. So just remember, keep in mind, net income in 2011 was $226 million, and even operating income was $376 million. So now for the most present data, we're looking at 2015 here, and from 2013, they jumped from $4.3 billion of revenue to $6.8 billion in 2015. So revenue's growing really fast, but here's where it starts to get a little interesting. So they have improved. They even hit $403 million in 2014. It dropped to $306 million in 2015. So again, you're just seeing those fluctuations. Something is not consistent in their business model, or their costs are expanding for reasons beyond what are necessarily visible from the financial statement. But this is something you would want to dive into as an investor and scrutinize heavily. But from there, this is where we're seeing less consistency once again. So again, they had about $260 million of profit in 2011, and as of 2015 this is down to 123 million. So there's just that inconsistency. It has dropped. That's why you're seeing a negative earnings per share and net income growth rate on an annual basis. This has dropped, and now the question is why, and this is the biggest red flag to date. So we are seeing, okay, positive operating cash flow to this point, but this dropped to negative $749 million in this past year. And that is a big, big concern, at least in terms of looking what did they do and why is their cash flow so negative? Well, looking above here, you can see that it looks like their biggest push is related to this additions to streaming content assets. So they were acquiring various assets, whether that was intellectual property or certain television shows, movies, you name it. They're trying to build up their surplus, which certainly can help, but only if it benefits your bottom line and you're not just adding revenue for the sake of revenue. Maybe it attracts customers and you're seeing that from a revenue standpoint, but that's still a huge push and you're seeing this negative. So what's next? Well, essentially this tells you that in 2015, they lost $750 million of cash. Their cash pile basically dropped by that much. How do they offset this? Well, you can see that in terms of issuing debt, this jumped from $400 million in 2014 up to $1.5 billion of debt in the next year. So that is a huge, relatively speaking, amount of debt that they have added on. I don't think it's overly concerning based on, the amount of profits they've at least been able to bring in. But now you have to take on the interest that is associated with this and eventually pay this principal as well. Ideally, you never really have to take on debt to support your growth, but in this case, that's what you're seeing they've done. They've made that choice. And then lastly, you can see that reflected in their balance sheet. So their long-term debt from 2014 to 2015 jumped from $885 million to $2.4 billion today. And that's a huge increase. Again, now you have to factor in how much in interest expenses they're paying. And if we go back up to the statement of operations, you can see that on an annual basis that their interest expense went from 50 million the previous year up to 133 million. So that is a big jump, and you need to expect that as long as they have this much debt, they have to pay each year and probably more every year in terms of supporting their operations. Until they can pay down that debt, this is a big concern here. And so now we've looked at a pretty comprehensive analysis of their financial statements. We can go back and, as I've said, just looking at everything between the price to earnings ratio as well as the negative earnings per share, negative net profit, they got negative free cash flow here, all red flags and not really strong margins. This is a company that I just don't firmly believe in. Now, here's the question. Here's the dilemma I always face and it always gets brought up to me in these videos, is when I say a company is overvalued, well, people immediately say that I should short the stock. And I've always had a lot of apprehension towards shorting businesses because there's a lot of additional risk. The max return you can get is 2x your return, but the potential losses are infinite. If this stock continues to skyrocket into the future, well, that's money lost that you're taking a major risk, and you need to essentially try and get out of your contract in order to prevent massive losses. So in most cases, it just makes sense to pass. And I think that's what I'm going to do here. So looking at this business, once again, one final summary, we're seeing from January 2016, a media company with a $5 billion market cap, a price to earnings of 42, a negative earnings per share growth, negative net profit growth, and negative free cash flow with weak margins. I'm going to take a pass on this stock. And let's see if my decision was right. So, in this case, it actually highlights that the stock continued to appreciate. And funny enough, this is actually Netflix. So, this is a great example where even my assessment was wrong. You're not always going to be right on everything. The stock actually appreciated 738% from 2016. What I did, based on my decision, is pass and avoid taking on unnecessary risk. On the other hand, you can see that if I decided to short the stock, I would be down bad. In my position, I would probably be close to bankrupt at this point in terms of compoundal. But overall, it's one of those that sometimes you're going to miss on companies. All the signs did not look favorable at the time, and so I was willing to take a pass on the business. Do you think I made the right decision? What did I miss in my analysis that could have improved the signs, at least in terms of making this investment in that moment? But we live for another day. If you enjoy the content, make sure to like and follow.